2026 is already shaping up. Just a few years in, it's already shaping up to be a year where policy, not just performance, is driving the conversation with regards to the economy and the stock market. Of course, we're continuing to see AI acceleration. Add that to the interest rate cuts that we continue to talk about in this midterm election year that creates uncertainty. There's so much to digest. Hi, my name is Ryan Olson. I'm a financial advisor in San Luis Obispo, California. I've been serving our clients for over 20 years. And in this video, part 2 of our 2026 outlook, I'm going to share key insights from the LPL Financial Research team and their outlook report. We're going to help you better understand the road ahead and what that could mean for your financial goals. Now, we are fortunate to have direct insights from some very well-respected and highly intelligent people over at LPL Financial. So I'm going to dig into 4 key points that they make for 2026 and give you my take on what they're saying. There's so much more to this report, more than the 4 points that I'm going to discuss. I'm not going to get into all of it, well, because it's a lot. I think I might bore you a little bit, but if you like a copy of the full report, the one I'm going to refer to throughout this video, please drop us a line and we'll send one over. We'll give you a link in the description below, and we'd love to provide you with that information. First key point, let's talk about the big picture. And this is pulling directly from Jeremy Roach, who's LPL's chief economist. Now, according to the LPL Financial Research team and Jeremy, the U.S. economy is expected to slow in early 2026, and then that's going to be followed by a rebound later in the year. And this is all driven by ongoing AI investment and fiscal stimulus from the One Big Beautiful Bill Act. The OBA is what some people are calling it. Now, remember, this act, it's a policy initiative that's expected to inject meaningful capital into infrastructure and innovation. And what that means is it should spur economic growth and help GDP pick up a little bit. The LPL team's anticipating that the Federal Reserve is going to continue to cut interest rates. That's widely anticipated and accepted as kind of common prediction at this point. And, that's going to aim to balance inflation concerns with a cooling labor market. Now, that combination is going to help keep the U.S. economy on a positive track, or could help keep the U.S. economy on a positive track. Though, we continue to expect volatility to be very much a big part of the picture. Digging a little bit deeper into what's going on at the Federal Reserve, we've got a backdrop of supportive monetary policy cycle. Now, Jeffrey Buchbinder, who's the chief equity strategist at LPL Research, is stating that the federal rate cycle should provide another tailwind for stocks in 2026, as it did in 2025. We're going to look at figure 7 of the report. We'll put that up on the screen. On page 10 of the report. Now, if the economy holds up, rate-cutting cycles tend to be followed by stock market gains. Stocks prefer rate cuts that are luxuries, not rate cuts that are emergencies. And that's a key point with what's going on at the Federal Reserve. LPL categorizes the upcoming rate cuts as the former. It's a luxury. It's not an emergency. The Fed is normalizing rates. It's not staving off an impending recession at this point. Again, that's a supportive monetary policy cycle. Buchbinder continues, this rate-cutting cycle is unique because stocks are near all-time highs. Now, in previous instances, when the Federal Reserve cut rates, stocks were at or near record highs. LPL's team found 28 cases there. And the S&P 500 was 13% higher on average 12 months later. That's pretty impressive, 13% higher a year later, with 93% of those 28 periods producing gains, 93% out of 28 periods. So there's some consistency there. Now, if we filter that a little bit further, when the U.S. economy was not in recession around the rate cut, the average 12-month return for the S&P 500 increased to 18%. That's up from the 13% previously noted, with gains in all 21 periods. Near recessions, the S&P 500 lost 2.7% on average in the 12 months after the Federal reduced rates, with only 25% of periods generating a gain. So that's a key point right there, right? What Mr. Buchbinder is stating is that if we're not near recession, that's a very optimistic outlook for what's ahead in the next 12 months. And so hopefully that's what comes to pass. Moving on to the third key point here, and these are market themes. In the report, LPL Financial points out they believe the bull market that began in 2023 may likely continue in 2026, and this is supported by strong corporate investment in AI and ongoing monetary easing. We referenced that before. Now, Buchbinder continues, and stay with me here because I'm going to read directly in the LPL report, and I'm going to pick up some steam here. The AI frenzy is being reflected in analysts' expectations for double-digit earnings growth for S&P 500 companies overall both this year and next. The Magnificent Seven have been responsible for more than half of the S&P 500 earnings growth of the past few quarters and will likely continue to play a significant role in growing earnings in 2026. While the wide gap between the Magnificent Seven's earnings growth and the rest of the market will likely persist well into 2026, supporting large-cap growth stocks expect this gap to narrow as the year progresses. This is something to watch closely when the calendar turns, as it could spark a market rotation into value stocks. There's a key point right there. So what Mr. Buckbinder is saying is, watch out. There might be a shift from the AI-driven markets, those Magnificent Seven stocks that are involved in that growth, to value stocks, the more dividend-paying type stocks. And so that's something to pay attention to in your portfolios. Now, Buckbinder continues, digging deeper into the AI conversation. Perhaps the most powerful investment cycle affecting stocks is the wave of AI capital investment. Consensus estimates for 2025 capital expenditures, they refer to that as CapEx in the industry, from the 5 hyperscalers, that's Google, Amazon, Meta, Microsoft, and Oracle, in 2025 are expected to come in around $400 billion. In 2026, that number is now expected to approach $520 billion, a roughly 30% increase over this year's estimate, and an estimated 1.6% of the U.S. economy in corporate profits. Nothing is bigger than AI right now, and that is very unlikely to change anytime soon. That's a pretty bold statement right there. 1.6% of the U.S. economy coming from this investment from the hyperscalers. That's a big deal, which is the one reason AI is getting so much attention right now. Now, the report does touch on international and emerging market equities. I'm going to save that for another conversation. In short, LPL's research is still favoring U.S. equities over international equities, slight overweight to U.S. stocks. Pausing here, with all that optimism, the LPL team, very reasonable, is also pointing to elevated stock valuations and the historical volatility that comes with a midterm election year, and that should temper your expectations. Now, I agree with this point. We've had an excellent run in stocks over the past couple of years, coming out of a bad year in 2022. So not a lot of technical analysis in this opinion, but typically what we see in the law of averages is that after we've had a few good years, there's going to be some volatility. We might have a rough year ahead. Now, their forecast is placing the S&P 500 between 7,300 and 7,400 by the end of the year. And again, that's LPL's view, not a prediction from me personally, but they're still optimistic with some tailwinds in the economy. Now, here's a real big key point, in my opinion, because we see how the media tends to dominate headlines and sometimes can sway market conditions one way or the other. And we're looking at figure 10 of the report, and this has to do with midterm elections, which are introducing a fresh layer of uncertainty around the future political makeup of Congress. Now, in 2026, all 435 seats in the House of Representatives and 1/3 of the Senate's 100 seats will be contested. Now, the outcome of these elections could have far-reaching implications for federal regulations, fiscal policy, taxation, and broader economic initiatives. They will also serve as a key referendum on President Trump's political agenda. Now, since taking office, Trump has secured a number of legislative victories under a Republican-controlled Congress. These include OBBBA, the One Big Beautiful Bill Act, the Genius Act, the Halt Fentanyl Act, the Recession Act, and nearly 200 executive orders spanning a wide range of policy areas. However, the Republican majority in the House is razor thin, as they hold just 219 seats, one more than the 218 needed for control. This represents the slimmest margin since 1931 and significantly increases the risk of a shift in power next fall. Historical trends reinforce this vulnerability. In 20 of the last 23 midterm elections, the president's party has lost seats in the House, with an average decline of 27 seats. That's incredible. Now, in the Senate, Republicans hold a 3-seat majority, with Vice President J.D. Vance providing a tie-breaking vote. So for Democrats to reclaim the Senate, they would need to flip a minimum of 4 seats. It's a difficult task that would require a combination of defeating 3 Republican incumbents in states Trump won in 2024 and capturing seats in Michigan or Georgia, which also swung Republican in the last presidential election. So for markets, political uncertainty in Washington translates into volatility, and that can weigh on our investor sentiment. We all know that. That's been ever omnipresent in our lives in the last 10 to 15 years. Now, historically, midterm years have been challenging for equities. Since 1950, here's a key point, the S&P 500 has averaged a modest 4.6% gain during those midterm years, with an average maximum drawdown of 17.5%, making it the most volatile and weakest performing year in the 4-year presidential cycle. Now, what happens from that is investors typically adopt a wait-and-see approach leading into November, with most of the year's gains historically occurring after the election day. And once that political uncertainty subsides, markets tend to rebound. In fact, the S&P 500 has posted an average gain of 14.5% in the 12 months following midterm elections and finished higher every time over the last 75 years. Now, remember here, and LPL Financial is keen to point this out, past performance does not guarantee future results. All right, we're coming to a bottom line here. The stock market in 2026 really could look a lot like 2025. Some of the cyclical drivers we've discussed in this video from the past year are continuing into the coming year, and we believe that this bull market should keep running, as most do at this stage in the cycle. We've got support from AI, we've got that rate cutting cycle happening. Now, given the rich valuations and the propensity for higher volatility in the midterm years, a lot must go right for stocks to enjoy another strong year to the level of 2025. But LPL's best advice is to stay invested in equities, target the weights that they're going to discuss. We're going to show you some images on that, and wait for corrections before considering raising your equity exposure or investing new cash. That opportunity is likely to come soon, though, so keep an eye out. Now, the report goes on to talk about the opportunities in bonds and alternative investments. I'm going to save that for another conversation as well. Really drawing this back in is, what does this mean for you? What does it mean for your portfolio? While it's impossible to predict every turn in the road, having a plan that's built to adapt matters more than ever. Now, Mark Zawicki, LPL Financial's CIO, puts it perfectly. He states, what does this all mean as we peer into 2026? And moreover, what does that mean for investors at large? Well, we believe, and he's talking for LPL Research, that in a tactical investment environment where policy shifts and market momentum increasingly outweigh fundamentals and valuation, investors should remain patient, avoid overreacting to short-term sentiment swings. The reason for that, policy and momentum-driven markets historically cause severe fluctuations in price. And these severe fluctuations can challenge behavioral biases to which we're all susceptible. We have seen as much in 2025 as equity prices swung wildly from policy-induced lows to momentum-driven highs, and we expect this pattern to generally higher volatility to only persist in 2026 and beyond. All right, thanks for sticking with us. There was a lot in that video. Now, again, if you'd like to get a full report, get this LPL outlook, let us know, drop us a line, and we'll send one over. Also, if you'd like to see how your strategy stacks up against today's market dynamics, we offer a free, no-obligation financial analysis delivered via video. It's personal, clear, and easy to review on your own time. Click the button on the screen, and we'll get you set up. Thanks for watching, everybody. Again, my name is Ryan Olson. I'm a certified financial planner at Mustang Private Wealth. We're located in San Luis Obispo, California, and serve our clients all over the country. Don't forget to subscribe to our YouTube channel by clicking the button on the screen, and we look forward to talking with you soon.